Seasoned Investor Part 13. Hello and welcome to today's video. In this video, we'll see three main reasons why getting a dividend stock in your portfolio might be a good option than going for a non-dividend paying stocks. At times, dividend paying stocks, they tend to outperform a non-dividend paying counterpart. We'll see the reasons why. And we'll also see why you should pick them as a part of your investment strategy. So like and subscribe this channel right away so that this video reaches a lot of people. So we all know when you buy a stock of a company, you become a partial owner of the company. So suppose you purchase 10% stock of a particular company, say company A, you become a 10% owner of that company. And you're liable for everything that the company gets for the amount of shares that you have. So you're liable for the 10% profit, 10% losses, and everything in proportion to the ratio. Everything in proportion to the percentage of shares you own for the company. But while you are a partial owner of the company executives would actually take a decision on your behalf as to what they should do with the money or the profits that the company earns. They can take a call to reinvest the profit into the company and grow the business, bring in more business and expand. Or they can decide to pay it off as a dividend to the shareholders, to you or any other shareholder. Now we all know when profits are shared with the shareholders in this fashion, in this manner, these profits are known as the dividends. We know that already. Now, what are the reasons why a dividend paying stock is a popular choice amongst the investors in comparison to the non-dividend paying stocks? Mainly there are three. The first of which is for dividend paying stock companies, these companies must keep cash at hand. See, in accounting practices, if you go through the company annual reports, you will find there is a standard and every company must follow that accounting principle while they present their company's financials to the public. But in doing so, there are a lot of assumptions and estimations. And with each instance of estimate and assumption, a company gets a chance to manipulate its accounting statement. They get the opportunity to manipulate their income statement and make profits look higher or lower than they actually are. Now, for dividend paying companies, here is a problem. You cannot fake liquid cash, which is the most common form of dividend. So, as a benefit, when a company pays dividend, it boosts the confidence for the shareholders that this company is making profits. And that's the reason why they are paying out dividends. They are making the profit that the company claims. Now, just think if a company regularly increases their dividend payout, this instills a serious confidence in the shareholders' mind. They know this company is going profitable year on year basis. They are increasing their dividend payouts every year. That's such a positive news for any shareholder. The second reason why dividend paying stocks are mostly preferred is because dividend paying companies or the promoters of these dividend paying companies should be more disciplined. They demand discipline. Now, what do I mean by this? What does this statement stand for? Now, for any company that has gone public, it's mandatory to share their income statements to the public, as well as the profits. At least if you do not share the profits, at least you should turn on the profits. That's the main intention for running a company and going public. The reason behind liquidating your company to the public is to, obviously, to gather the capital and then return the shareholders' money in terms of profits. So in doing so, dividend actually, it improves the accuracy of the income statement, and it also adds pressure to the promoters to instill discipline. Why? Because as a promoter, it's mandatory for you, or it becomes essential for you to keep cash at hand, because you know the dividend paying or dividend payout date is coming up. It's very near. Now just imagine at this point of time when the dividend payout date is very near to him and In a moment like this, if the promoter comes across an opportunity, he gets to decide whether the opportunity that is in front of him would generate the cash requirement for the dividend payout for the shareholders. Is this opportunity good enough for the company to have the dividend payout which they promise to give to the shareholders, which they generally give out to the shareholders on a year-on-year basis? Would I go and plunge into a new venture or take up this opportunity because I know that I'll have to pay out my dividends this year, next year, whatever it is? I have a good trend of increasing dividends every year. Should I break that or should I take up this opportunity? That's a big question in front of the promoter. He has to take a call. Now, when he has to take a call, he then has to decide whether this is a risky investment or is it a profitable investment. If it is a risky investment, if he thinks this is not going to meet his dividend obligations, he might pass it on. He might say, okay, fine, I'll not take this up. That way, he reduces investing in a risky investment, in a risky asset, in a risky venture. You, me, our money is in safe hands because the promoter of the company takes a good decision. He does not invest in just anything in anticipation to grow the company. He doesn't take rash decisions. Now, on the other hand, just imagine the same CEO, the same company. Now, this time, this company doesn't have a dividend obligation. This is not a dividend paying company anymore. It's a company which does not pay out dividends. For a company like that, what will the CEO do? He might take up the opportunity. He might say, okay, fine, it looks a little bit risky, let me take it up. God knows, maybe I can turn it into a profitable venture in future. Yes, he would analyze. Yes, he would do the thorough research. Yes, he would do all the necessary study that is required before he purchases that investment, before he puts his money into that investment. But then he doesn't have the obligation to make a dividend payout. He doesn't have the obligation to definitely make a profit, because there are people standing behind him who demands a dividend payout, who is looking for a dividend payout from him. That pressure is not with this guy. He might move on with a very risky venture in anticipation to make profit in future, maybe 3, 4 years, 5 years down the line. Because the instant or the immediate pressure of paying out or increasing payout of a dividend is not with him. Now let's see the third important factor why a dividend paying company is more preferable. It's because the yield support slows down the bearish forces. You might have seen in a major market downfall, a strong dividend paying stock tends to hold on to its price better than a non-dividend paying counterpart. This happens because of the yield support. So let's try and understand this with an example. Say suppose a company pays 3 rupees as a dividend for a 100 rupee share, which means it's paying out a dividend yield of 3%, right? Now just imagine in a falling market, the price of the share comes down to, say, suppose 50 rupees. I'm just giving arbitrary numbers to you. It doesn't have to be exact, but just for an easy calculation. So just imagine a 100 rupee share comes down to 3 rupees. Now that 3 rupee dividend would mean a 6% dividend yield, isn't it? Although the company might not pay out a 3 rupee dividend, but just take it into calculation that if the company still pays out the 3 rupee dividend, it would mean the company is paying in a 6% dividend yield. Now that's almost a guaranteed return, you can say. A 3% dividend yield becomes 6% in down market. That's a 6% guaranteed return. Any investor would just simply close down his eyes and throw all his money into the stock at this moment. You're getting 6% dividend yield. And also, if the stock fundamentals are good, if the stock moves up later on, the company is going to be profitable later on. It's going to bounce back when the market recovers. You will gain back the money that the company, lost. So you get a 6% guaranteed dividend yield, and on top of that, an opportunity of a lifetime to double your money. Anybody would jump into this company in situations like these. What happens when a lot of investors, plunge or throw in their money to buy a particular stock? There is a huge buying rush for that stock, for that particular stock. Now, this buying spree might slow down the downward movement of the stock. It might even happen that it might reverse it back. As I said, the company might not pay a 6% dividend yield. Now let me explain you why it sometimes it does not. This happens because when the dividend yield becomes very high, it breaks. And then it becomes very difficult because then the dividend payout becomes unsustainable and the company might not have the money to actually pay out the dividend. So what does these three main points they tell us? Very, very subtle points, but very, very much overlooked into the market. Although we investors would like to double our money, triple our money in a very, very short while, we might look forward for the next best IPO, the next sparkling IPO, or the next big IPO that's coming up. It's also advisable not to overlook these dividend paying stocks, because these stocks are already successful. These companies are already successful. These cash making giants might fill up your pockets slowly, steadily, not as fast as an IPO, but definitely at a slow and steady and a consistent pace. So do not overlook dividend paying stocks, because they may attract investors and turn their tables upside down. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.